Welcome back. Today, I'm going to say something that goes against one of the most commonly repeated pieces of advice in all of personal finance. Advice that is plastered across every financial blog, recommended by every online calculator, and repeated so often that it has become almost unquestioned dogma. That advice is always max out your 401k. Now, before anyone skip this video, I am not saying the 401k is bad. It isn't. It is one of the most powerful wealth-building tools available to American workers. And for the right person in the right situation, maxing it out is absolutely the correct move. But the right person in the right situation is not everyone. And the blanket, context-free advice to max your 401k above all other financial priorities leads a surprising number of people into decisions that actually slow down their overall wealth building rather than accelerating it. The financial industry has a clear incentive to encourage maximum 401k contributions. More assets under management generates more fees. Personal finance media repeats the advice because it's simple, it's easy to understand, and it sounds responsible. But the best financial decision for any individual is not always the one that sounds the most virtuous. It's the one that produces the best outcome for their specific circumstances. Today, we're going to look at the hidden downsides of blindly maxing your 401k. The situations where it's the wrong move, or at least not the first move, and give you a framework for thinking about this that goes beyond the oversimplified advice. Let's get into it. A 2022 survey by Vanguard found that only 14% of 401k participants contributed the maximum allowed amount in a given year. This means the vast majority of people are nowhere near maxing their 401k. And for them, the "should I max" question isn't yet relevant. But for those in the top income quartile who are debating whether to max or direct dollars elsewhere, the question has real financial stakes. The research on optimal asset allocation, which we'll cover in detail today, suggests the answer depends heavily on factors that the standard advice completely ignores. Chapter 1. The case for the 401k. What everyone gets right. Before we get into the downsides, I want to be genuinely fair about what makes the 401k such a powerful tool, because the reasons people advocate for maxing it are real and grounded in solid mathematics. This is not going to be a hit piece on the 401k. It's going to be an honest evaluation of when the conventional advice applies and when it doesn't. The core advantage of a traditional 401k is tax deferral. Every dollar you contribute to a traditional 401k comes out of your gross income before federal and state income taxes are applied. If you're in the 24% federal tax bracket, a $23,000 contribution effectively costs you only $17,480 in real take-home dollars. The federal government is subsidizing $5,520 of your contribution through tax savings, and then those dollars grow tax-deferred inside the account, meaning you pay no capital gains taxes, no dividend taxes, and no income taxes on the growth until you withdraw in retirement. Over a 30-year compounding period, the tax deferral advantage is enormous. The classic rule of thumb suggests tax deferral adds roughly 0.5 to 1% to effective annual returns for most investors, not because the underlying investments perform differently, but because more of the growth is retained rather than paid to the IRS along the way. Research by Damon, Spat, and Zhang, published in the Journal of Finance, found that optimal asset allocation, placing the right investments in tax-advantaged versus taxable accounts, can improve after-tax wealth by 10 to 20% over a 30-year investment horizon compared to tax-naive asset allocation. The 401k is the primary vehicle for capturing this asset location advantage, and for investors with long time horizons and substantial taxable income, the tax deferral benefit is genuinely significant and difficult to replicate elsewhere. The second and more straightforward 401k advantage is the employer match, and this one requires almost no nuance. If your employer matches your contributions up to a certain percentage of your salary, that match is a guaranteed, immediate return on your investment that no other financial vehicle can compete with. A 50% match is a 50% instant return. A 100% match is a 100% instant return. These are pre-tax dollars that double the moment they land in your account. There is essentially no scenario where declining to capture your full employer match is a rational financial decision, unless you're facing genuinely emergency-level financial circumstances, like impending eviction or zero food security. Everything else, including paying down debt, building an emergency fund, or investing in a taxable brokerage, should come after you've contributed at least enough to capture the full employer match. This specific piece of the conventional advice is correct and essentially universal. The Vanguard How America Saves report found that only 37% of 401k participants were contributing enough to capture their full employer match. This means that nearly 2/3 of participants are leaving free money on the table, the most quantifiable financial mistake a working American can make. The uncaptured employer match across the U.S. workforce amounts to billions of dollars in foregone compensation annually. So, to summarize where the conventional advice is right, always contribute at least enough to get the full employer match. For most people, that is the 401k first dollar and the 401k priority. Full stop. Now, here's where it gets more complicated. Everything above and beyond capturing the employer match, the decision to contribute beyond the match, all the way up to the $23,000 annual limit, that decision is not as simple as the conventional advice suggests. And here are the hidden downsides that most financial media doesn't tell you about. The hidden downsides. What the advice gets wrong. Downside number 1. Your money is locked until 59 and a half, and life happens before them. The 401k is specifically designed for retirement. That sounds obvious, but its implications are profound and frequently underappreciated. Every dollar you put into a 401k is, under normal circumstances, locked until age 59 and a half. If you need it before then, you face a 10% early withdrawal penalty, plus ordinary income taxes on the full amount withdrawn, a combined cost of 30 to 45% of the withdrawal for many tax brackets. In practice, this means a dollar in your 401k is worth significantly less than a dollar in a taxable brokerage or a high-yield savings account if you need it before retirement age. This illiquidity is a fundamental characteristic of the 401k, not a bug that can be engineered around. Yes, there are hardship withdrawals, 72T distributions, the rule of 55 for certain workers, and 401k loans, each with their own set of costs and complications. But none of these alternatives makes a 401k genuinely liquid. They are all mechanisms for accessing locked money, and they all come with material costs or restrictions. The risk this creates is real and specific. Consider someone in their 30s who maximizes their 401k every year, building a growing balance of locked retirement savings. Life events that require capital, a job loss, a business opportunity, a medical emergency that exceeds insurance coverage, or a family crisis, cannot be addressed by that 401k balance without significant penalty. If that person has no liquid savings because every available dollar went into the 401k, they are paradoxically less financially resilient despite having a larger nominal net worth. Data. Research by the J.P. Morgan Chase Institute on household financial resilience found that liquid savings, accessible cash, and cash equivalent accounts was the primary predictor of household financial stability during income shocks, far more so than total net worth or retirement account balances. Households with low liquid savings but high retirement account balances showed outcomes during financial emergencies similar to households with low savings overall, because the retirement savings, while nominally valuable, could not be accessed without significant cost. The researchers found that a liquid buffer of $2,000 to $5,000 was worth disproportionately more than larger locked retirement balances when households faced unexpected expenses. Practical implication. For someone who has not yet built a fully funded emergency fund of 3 to 6 months of essential expenses in a liquid, accessible account, directing additional dollars toward a 401k beyond the employer match may be creating nominal wealth while reducing actual financial security. The emergency fund should generally be established before 401k contributions exceed the match threshold. The right sequence: employer match first, always, emergency fund of 3 to 6 months next. Then decide: max the 401k, fund a Roth IRA, pay down debt, or invest in a taxable account, in whatever priority makes sense for your specific situation. Downside number 2. High interest debt costs more than the 401k tax benefit saves. One of the most financially damaging versions of always max your 401k advice is when it leads people to make 401k contributions while simultaneously carrying high interest consumer debt. The logic seems sound on the surface. The 401k has a guaranteed employer match, a tax deferral benefit, and the potential for long-run investment returns. But when the debt in question carries an interest rate above 8 to 10%, the guaranteed cost of that debt exceeds the expected benefit of the additional 401k contributions beyond the match. Let's be concrete. Credit card debt in 2024 carries an average interest rate of approximately 21%. Every dollar you don't pay toward that debt is generating a guaranteed 21% cost, a return on investment that is essentially impossible to beat with any legal investment strategy, especially when you account for taxes, fees, and the realistic probability distribution of market returns. The 401k tax deferral benefit typically adds 0.5 to 1.5% to effective returns, depending on your tax bracket and time horizon. The employer match beyond the baseline contribution percentage doesn't exist for contributions above the match threshold. So the comparison for dollars above the employer match threshold is approximately this. Directed to 401k beyond the match, those dollars generate market returns plus a tax deferral benefit of maybe 1% annually. Directed to paying down 21% credit debt, those same dollars generate a guaranteed 21% return. The math is not close. Data. Research by economists analyzing optimal financial decision-making sequencing found that for most households with high interest debt, the optimal allocation of additional savings dollars after capturing the employer match is to direct those dollars toward debt elimination rather than additional tax advantage contributions until the debt is eliminated or reduced to a low interest rate level. The guaranteed return from eliminating 20+% interest debt consistently outperforms the expected risk-adjusted return from equity markets over any comparable period. The researchers noted that behavioral factors, the psychological reward of building a growing investment balance, sometimes lead people to prioritize investing over debt elimination, even when the math clearly favors the latter. The threshold where this calculus shifts is roughly 7 to 8% annual interest. Below it, the long-run expected return from invested capital likely exceeds the cost of carrying the debt, and the case for investing alongside moderate-cost debt is reasonable. Above it, paying down the debt is almost always the better financial decision than additional 401k contributions beyond the match. Downside number 3, you may pay taxes at a higher rate than you expect in retirement. The traditional 401k's core tax argument is straightforward. Contribute now at your current, presumably high, tax rate, withdraw in retirement at a lower, presumably lower, tax rate, and capture the difference as a permanent tax savings. This logic is sound if the assumption holds that your tax rate in retirement will be meaningfully lower than your tax rate during your working years. But for a growing number of Americans, particularly those who successfully build substantial retirement wealth, that assumption may be partially or completely wrong. Here's the scenario that catches people off guard. A diligent saver who has spent 35 years maximizing their 401k reaches retirement with a balance of $1.5 million to $2 million. At age 73, required minimum distributions kick in, mandatory annual withdrawals calculated based on the account balance and IRS life expectancy tables. At $1.5 million with a typical RMD calculation, the required annual withdrawal is approximately $57,000 in the first year, rising each year as the balance grows and the divisor decreases. Now add their Social Security income, let's say $28,000 per year. Their total reportable income is $85,000 or more annually. That puts a single retiree solidly in the 22% federal tax bracket, the same bracket they may have been in during their moderate income working years. If they live in a high tax state, their combined marginal rate could exceed 30%. The tax deferral benefit they expected, the rate differential between their working and retirement years, partially or fully evaporates. Research by financial planners Ed Slott and others in the retirement distribution literature has documented the tax time bomb problem. Traditional 401k holders who have been highly successful savers often face required minimum distributions that push them into higher tax brackets than anticipated, triggering not only income taxes, but also Medicare IRMAA surcharges, premium increases triggered by income above certain thresholds, and increased taxation of Social Security benefits. Studies estimate that for high-balance 401k holders, suboptimal Roth conversion planning can cost $100,000 to $300,000 or more in additional lifetime taxes compared to a strategically diversified tax approach. The solution to this downside is not to avoid the 401k. It's to build a tax-diversified retirement portfolio that includes both traditional, pre-tax, and Roth, after-tax contributions spread across different account types. For many earners, particularly those in the 22 to 24% federal tax bracket, contributing some dollars to a Roth 401k, if offered by the employer, or a Roth IRA rather than exclusively to a traditional pre-tax 401k, produces better after-tax lifetime outcomes, even though it costs more in taxes today. Downside number 5. Many 401k plans have poor investment options and high fees. Not all 401k plans are created equal. While the best plans, typically offered by large employers who have negotiated institutional pricing, offer excellent index funds with expense ratios below 0.10%, a significant portion of 401k plans, particularly those at smaller employers, are loaded with expensive, actively managed funds with expense ratios of 0.5% to 1.5% or higher. In some plans, the only available funds carry fees that would make any independent investor wince. This is not a hypothetical concern. It is a documented and widespread problem in the 401k industry. The fee differential between a good 401k plan and a poor one can be the difference between a retirement balance that's hundreds of thousands of dollars larger or smaller on identical contributions and identical time horizons. The Department of Labor has estimated that a 1 percentage point difference in annual 401k fees can reduce a worker's final account balance by approximately 28% over a 35-year career. For a worker contributing consistently over 35 years at a 1% higher expense ratio versus a low-cost alternative, the fee drag on a $500,000 final balance represents roughly $140,000 in foregone wealth, money paid to fund managers for performance that, as the SPIVA research consistently shows, fails to outperform the index that cheaper funds track. The practical implication is, before deciding to max your 401k, look at what's actually in the plan. Go to your plan's investment menu and check the expense ratios on every available fund. If the cheapest index fund available in your plan charges 0.50% or more, and you have the option to invest in a Roth IRA at Fidelity or Vanguard with access to 0.03% index funds, the math may favor maxing the Roth IRA before maxing maxing the employer 401k beyond the match, even accounting for the tax deferral benefit, which may be partially or fully offset by the higher fees. Check your plan. Look up every fund in your 401k and find the expense ratio for the cheapest available index fund. If it's above 0.50%, your plan has high costs that should factor into your savings allocation decision. If it's below 0.15%, your plan is well managed and the tax deferral benefit is largely uncanceled by fees. Downside number 5, illiquidity costs you options, including investment opportunities. This downside is more nuanced and slightly controversial, but it's grounded in both research and real-world financial planning. When every available investment dollar is locked in a 401k, you lose the flexibility to pursue investment opportunities that may arise outside of retirement accounts. Investing in a business, participating in real estate deals, funding a child's education, taking advantage of taxable investment opportunities during market downturns, or providing a down payment on a property that generates rental income. For someone who has specific, credible plans for deploying capital in ways that could generate returns above what their 401k would produce, a business owner, an aspiring real estate investor, a person with specialized knowledge in a particular asset class, locking every dollar into a 401k before age 59 and a half forecloses those options entirely or forces expensive penalty-laden workarounds. This is not an argument for skipping retirement savings in favor of speculative investments, but it is an argument that a rigid max the 401k first rule fails to account for the legitimate value of maintaining financial flexibility, particularly for people in their 30s and 40s who may face major capital allocation decisions that don't fit neatly into a retirement account wrapper. Research by economists Hurst and Lusardi on entrepreneurship and liquidity constraints found that households with access to liquid wealth were substantially more likely to successfully launch businesses and take on career risks with positive expected value outcomes. The liquidity constraint, having capital locked in retirement accounts while needing it for a business or investment, reduced the probability of beneficial risk-taking in a way that for some households represented a larger opportunity cost than the tax deferral benefit of additional retirement contributions. Downside number 6, the Roth IRA is often a better vehicle for many earners. For earners below certain income thresholds, $161,000 for single filers and $240,000 for married filing jointly in 2024, the Roth IRA may represent a better after-tax savings vehicle than additional traditional 401k contributions beyond the match. Roth contributions are made with after-tax dollars, meaning you get no tax deduction today. But the growth and qualified withdrawals are entirely tax-free, forever. No RMDs, no income taxes on withdrawals, complete flexibility to withdraw contributions, not earnings, at any time without penalty. For younger earners who are likely to be in higher tax brackets in peak earning years and who have a long time horizon for tax-free compounding, the Roth IRA's after-tax growth often outperforms the traditional 401k's tax deferral advantage on a lifetime after-tax basis. And for those who expect to have substantial 401k balances that will generate significant RMDs in retirement, the Roth IRA provides a critical source of tax-free income that can be managed strategically to minimize lifetime tax burden. Research by financial planning academics comparing traditional versus Roth account strategies across different income and tax scenarios found that for earners in the 22 to 24% federal tax bracket, a large and growing share of the workforce, contributing to a Roth IRA was superior to additional traditional 401k contributions beyond the employer match in a majority of modeled scenarios when total lifetime taxes were calculated. The key variable was whether marginal tax rates in retirement would be lower, equal to, or higher than current rates. And for substantial savers, there is a meaningful probability of rates being comparable rather than lower. The practical order for many middle-income earners: capture the full employer 401k match, build the emergency fund, then fund the Roth IRA to the maximum, $7,000 in 2024, or $8,000 if 50 or older, and only then consider additional 401k contributions beyond the match. This sequence provides a tax-diversified retirement portfolio, maintains some investment account liquidity through the Roth IRA's contribution withdrawal flexibility, and captures all available employer matching. Chapter 3. The Optimal Savings Sequencing Framework. Okay, we've covered the downsides. Now let's build a positive framework for thinking about savings allocation that's more nuanced and more personally relevant than always max your 401k. The academic and planning literature generally supports what's sometimes called the financial order of operations, a priority sequence for allocating savings dollars that accounts for the relative value of different financial moves. Research-supported optimal sequence for most working Americans generally looks like this from highest priority to lowest. First, capture the full employer match. As we've established, this is as close to a universal recommendation as exists in personal finance. It's a guaranteed return that no alternative can match. Second, eliminate high-interest debt, specifically anything above 8 to 10% annual interest. The guaranteed return from eliminating this debt exceeds expected returns in virtually all scenarios. Third, fund a fully loaded emergency fund of 3 to 6 months of essential living expenses in a liquid, high-yield savings account. This prevents the 401k from becoming your de facto emergency fund at a 30 to 45% penalty cost. Fourth, fund a Roth IRA to the maximum if eligible by income. Tax-free growth, no RMDs, contribution withdrawal flexibility, and access to the best investment options available. This is a powerful vehicle that many earners should prioritize over additional 401k contributions beyond the match. Fifth, if you have an HSA-eligible health plan, maximize the health savings account. The HSA offers a triple tax advantage: pre-tax contributions, tax-free growth, and tax-free withdrawals for qualified medical expenses that makes it arguably the most tax-efficient savings vehicle available to American workers. Sixth, additional 401k contributions beyond the employer match threshold up to the annual limit if your plan has good low-cost fund options. Seventh, taxable brokerage account investing for goals that don't fit neatly into the retirement account structure: business capital, down payment funds, early retirement aspirations, or simply maintaining investment flexibility. A 2021 analysis by the Financial Planning Association found that households following an optimized savings allocation sequence, prioritizing in a manner that maximized after-tax wealth and maintained appropriate liquidity, accumulated on average 12 to 18% more after-tax wealth over a 25-year horizon than households following a simple max the 401k first rule, even when total savings rates were identical. The difference was driven by reduced tax burden through Roth diversification, elimination of high-cost debt, and avoidance of penalty-triggering early withdrawals. In the interest of complete fairness, let's also be specific about when blindly maxing your 401k is actually the right call, because for some people in some situations, it genuinely is. You're in the 32% federal tax bracket or higher. At high marginal rates, the tax deferral benefit of the traditional 401k is large enough to outweigh most competing uses of those dollars. The higher your bracket, the more valuable the pre-tax contribution becomes. You have no high-interest debt and a fully funded emergency fund. If the foundational building blocks are in place, maximizing the 401k becomes a much cleaner decision. You're in your peak earning years with a 15-plus year runway to retirement. Tax deferral compounds most powerfully over long periods, and the liquidity concern diminishes as retirement age approaches. Your 401k plan has excellent low-cost index funds. If the investment menu is genuinely good, the tax advantages are largely uncanceled by fees. You've already maxed the Roth IRA and HSA. If those superior flexibility vehicles are fully funded, the 401k is the logical next priority. You have a clear, known high tax rate in retirement that will be lower than your working rate. For example, a teacher or government worker with a guaranteed pension will have a defined, calculable retirement income and a clear bracket transition. Chapter 4, The Tax Diversification Imperative, a message for high earners. I want to close the substantive portion of this episode with a concept that deserves much more attention than it typically gets in mainstream personal finance: tax diversification across account types. Most people understand investment diversification. Don't put all your money in one stock. Spread across asset classes. But relatively few apply the same logic to tax treatment. Don't put all your retirement savings in one tax structure. Having a mix of pre-tax, traditional 401k or IRA, Roth, after-tax, tax-free growth, and taxable accounts gives you extraordinary flexibility in retirement to manage your tax liability in real time. In a tax-diversified retirement portfolio, you can draw from Roth accounts in high-income years to avoid bracket creep. You can draw from taxable accounts in years when you want to take advantage of 0% long-term capital gains rates. You can draw from traditional accounts in low-income years when your marginal rate is minimal. This flexibility, which only exists if you've built a diversified tax structure during accumulation, is worth substantial money over a long retirement. Research by Wade Pfau and Michael Kitces on retirement income optimization found that tax-diversified retirement portfolios, those with assets spread across pre-tax, Roth, and taxable accounts, provided retirees with significantly higher after-tax income flexibility and lower lifetime tax burdens than portfolios concentrated in a single account type. The researchers estimated that optimal tax management across account types in retirement can be worth 0.5% to 1.5% in additional after-tax annual income, equivalent to what low-cost index fund investing saves over high-cost actively managed funds. The practical message? If your employer offers both a traditional and Roth 401k option, consider splitting contributions between both based on your current versus expected future tax situation. If you're eligible for a Roth IRA, fund it alongside your traditional 401k. The slight complexity of managing multiple account types is entirely worth the lifetime tax benefit it creates. Let me close with the core message of this entire episode. The best financial advice is not always the simplest advice. Always max your 401k is simple. It's easy to remember. It sounds responsible. And for some people, particularly high earners with no debt, a funded emergency fund, and good plan investment options, it is the right advice. But for the person carrying 20% credit card debt who's maxing their 401k because someone told them it's always the right move, it's costing them real money. For the person who will need capital in their 40s for a business or a home, who has locked everything in a retirement account, it's reducing their financial options. For the person who will retire with $1.5 million in a traditional 401k and no Roth balance and no taxable account, it's setting up a tax bill they didn't have to pay. The research-backed approach is not dramatically more complicated than the conventional advice. It's just more thoughtful. Capture the match, eliminate high-cost debt, fund the emergency account, build a tax-diversified portfolio that includes Roth, then, with all of that in place, maximize the 401k if your situation warrants it. The 401k is a great tool. Just make sure you're using it in the right sequence, at the right level, for the right reasons, rather than because it's the received wisdom of personal finance that nobody ever thinks to question. Thanks for watching. If this changed how you're thinking about your savings allocation, drop it in the comments. I want to hear how you're approaching this. Share it with someone who might be maxing their 401k while also carrying debt and wondering why it doesn't feel like it's working. Subscribe for the next one. See you there.